Hello and welcome to the latest portfolio update for June with me, Andrew Dawkins. So the month of June so far has been very good for all the funds that we have in our portfolio, all showing positive growth, which is good to see. The best performer, surprisingly, this month is actually from our Worldwide Property Fund run by Schroders, and this is showing growth of over 6% over the last 1 month. That's quite surprising. We then turn to the European funds, and European funds are second in the list and growing by over 4% in the last 1 month. And we're starting to see good returns now from Europe, and the economic deals that are in place to stimulate the economy are starting to be rolled out with 750 billion euros worth of funds and debt to be encompassed within that package. So get set for magical growth in Europe. Turning to fixed interest, this has now been a positive month. A lot of the funds have repositioned and we're starting to see better results coming from there. There's still the threat of inflation, which has now exceeded the Bank of England's target here in the UK for the first month for a long period of time, which again is reducing the returns on a lot of fixed interest investments as investors fear that the returns that they're currently receiving are going to be below that of inflation. So a move against that. But generally our portfolios are well positioned for recovery now. A lot of clients have moved their fixed interest holdings down, which is going to be good for the next wee while. In the UK market's done well. It's been a steady month, I think, really. Both the UK smaller and larger funds are doing very, very well and up just over 1%. Looks set for a good period with the economy opening up again, and hopefully that won't take too long now before we start seeing really good results over here. The Far East sector, that's actually improved somewhat. It was a fairly quiet 3 months or so for the Far East, but it started to show better growth just now, and almost 3% growth from our Far East funds over the last 1 month, and sort of looks set to deliver quite decent returns. A lot of the countries over there are starting to see good growth now. Still 1 or 2 areas that are affected by the third wave of COVID infections, and this is subduing markets, but generally good numbers coming out from a lot of countries over in that part of the world, so we're looking good. And finally, the US sector's had a very good 1 month so far, and we know from last month it wasn't particularly good for the last month, but this month the funds that we're using up around about 4.5% to 5%, so very, very good. And again, stimulus packages still to be announced in terms of the government there, but the Federal Reserve is continuing to pump vast amounts of money into the economy to keep that money supply nice and fluid. Stoking up fears of inflation again over the longer term. We can see from the jobs market now that we're almost back to pre-pandemic levels in terms of people actually being employed. So good news from there as well. So all in all, a very good month for June, and generally is a quieter period going into the holiday months, July and August, and that probably is going to be the case going forward. The big movements obviously on inflation, but the pandemic still centre stage with the rollout of the vaccines, hopefully making the world a better place. So looking at the performance of the 4 portfolios, the cautious portfolio over the last 1 month has grown by 1.9% and over the year by 11.7%. The balanced portfolio has grown by 2.2% over the last 1 month and over the last year 16.8%. Capital growth portfolio this month has grown by 2.5% and over the year by 22%. And finally, the aggressive portfolio this month is up 2.8% and over the year an impressive 26.4%. We thought thought it'd be quite interesting to look at the 5-year performance of the portfolios, since it's been 5 years now since the infamous Brexit exit vote. And for those of you with a long memory, you'll recall that we were quite excited about the Brexit vote, and one of the few people that thought it would actually be good for investments because it creates that volatility, and the volatility, as we know from last year, is very, very good for our portfolios long term. So if we look at the numbers, over the 5 years then, our cautious portfolio has now grown by 47%. The balanced portfolio is up 63%. Our capital growth portfolio has risen 78%. And finally, the aggressive portfolio has risen by 95%. We remain very, very positive, as we always are, and the portfolios are looking good to deliver excellent returns, if not outstanding, over the next wee while. So we'll stay tuned for the next update. Thank you for listening.